In 2021, an ordinary guy on TikTok turned $1,000 into $100,000 in cryptocurrency. Within a few months, his videos went viral with millions of views. He showed charts, profits, account screenshots. People wrote, "You changed my life. I'm starting today. This is my chance." A year later, his account disappeared. And the interesting thing is that he wasn't a scammer. He just got lucky at the right time. But the market took it all back. And there are millions of stories like this you never see because algorithms love success stories, not failures. And this is exactly where the myth of getting rich quickly begins. People believe in fast wealth not because of greed or laziness, but because they want to escape debt, a job they hate, stress, and constant scarcity. In the US, 60% of people live paycheck to paycheck, even earning $100,000 plus, which is called the financial pressure loop. When people see stories of overnight success, the brain says, "This could be my way out." Our brain evolved 200,000 years ago for survival, not investing. And the stock market has existed for about 200 years. So we are running a Stone Age brain in a digital economy. Neuroscience shows that anticipating instant reward activates dopamine more than the reward itself. Dreaming about fast money feels better than actually earning it, which is why lotteries are addictive, casinos thrive, and hype investments repeat over and over. Before the internet, people compared themselves to neighbors. Now they compare to millionaires. Every day we see luxury cars, trips, trading profits. Day in the life of entrepreneur, but nobody posts. Today, I invested long-term and nothing happened. Real wealth looks boring. Social media exaggerates extremes. In 1943, the U.S. analyzed planes returning from battles. They wanted to reinforce areas with the most bullet holes. But statistician Abraham Wald said, "No, reinforce the areas without holes, because planes hit, there didn't return." This is called survivor bias. In finance, it works the same. We see crypto millionaires, winning startups, successful traders. But stats tell another story. 90% of traders lose money. 90% of startups fail. Over 70% of crypto investors buy at the peak. People see only 1% and think the odds are 50-50. When the brain sees success, it thinks, "I can do that too," which is true, but they were in the right place, took risk, and got lucky. Luck is rarely discussed, and this builds the illusion that fast wealth is accessible to anyone. Thus, the myth of getting rich quickly is reinforced biologically, psychologically, and socially, creating the idea you can beat the system by mimicking others without seeing the hidden failures. Next comes FOMO, fear of missing out. Your brain screams, "Act now or lose your chance." In 2021 crypto boom, Bitcoin rose from $10,000 to $60,000. Most bought at $60,000 and lost 50 to 70% when the market dropped. This cycle repeats. Dot-com bubble, 2008 housing crash, GameStop, NFTs, hype assets. The pattern is the same. People see fast money, jump in late, lose, quick wins, create overconfidence. Overconfidence leads to bigger losses. Fast money disappears because 70% of lottery winners go bankrupt within years. 60% of NBA players go bankrupt within 5 years. Post-retirement, money does not equal financial literacy. Slow earners develop discipline, control, and financial mindset. Fast money lacks these skills. The brain treats it as easy money. Easy money is spent faster, risked more, lost more. Psychologists call this the house money effect. Traders who make $10,000 quickly often lose $20,000. The paradox of fast wealth. The brain does not respect easy money, and that is why it disappears. Now let's talk about real ways people get rich, including offline businesses. Most millionaires get rich slowly. 79% did not inherit wealth. Most invested 10 to 30 years. 3 pillars of wealth: time, consistency, and compound interest. For example, investing $500 monthly at 8% annual return gives $1 million in 35 years. Not fast, but guaranteed. Real-life cases. People starting with $50 at age 20, regularly investing in ETFs, now have 7-figure portfolios. Now think about offline businesses. Starting a small cafe, a restaurant, or a franchise may require $10,000 to $50,000. Profit grows slowly but sustainable. Many fail in the first year because they expect instant returns. You don't see social media videos of struggling cafe owners, only "I made $5,000 in a week selling online." Yet physical businesses compound wealth over years. Rental properties are similar. Buying a small apartment for $100,000 can generate $800 to $1,200 monthly cash flow. But investors forget about maintenance, taxes, vacancy periods. Yet over 10 to 20 years, property grows in value steadily. Real offline entrepreneurs understand patience and reinvest profits. Family businesses passed for generations show slow compounding. There are also hybrid approaches, online plus offline, like selling products in a shop and online store simultaneously. Example, a local bakery adding delivery and Instagram sales increased revenue by 300% over 2 years. Patience and discipline matter more than hype. Let's add some numbers. Imagine opening a cafe for $30,000. First-year profit, $5,000. Reinvest $2,000 each year. After 10 years, cumulative profit may reach $50,000 to $60,000. Slow growth, but tangible. Contrast this with someone buying meme coins expecting $50,000 in a month. Likely to lose 90% of investment, the psychological trap is identical. Fast money seems exciting. Slow money boring. The brain reacts to dopamine spikes. We want instant gratification. Now interactive question for you. How many times have you thought, "I'll make it big quick," then checked Instagram or TikTok to see someone else's $10,000 profit and felt jealous? That is the dopamine trap, and this is why slow, disciplined wealth building is almost invisible, yet highly effective. Let's talk more examples. In retail, opening a small clothing store may take $15,000 initial investment. First-year revenue, $40,000. Profit, $5,000. Compounding reinvestment, hiring staff, improving products creates a 10-year trajectory worth $100,000 plus in net profit, while online day traders may earn $10,000 in a month, but lose it in the next. Real wealth is boring, cumulative, predictable, patience-based. Same in services. Opening a local gym for $20,000. First-year profit, $2,000 to $3,000. Second year, $5,000. Third year, $8,000. After 10 years, it may generate $60,000 to $80,000. Cumulative again, slow but consistent. This is exactly why physical businesses are overlooked in fast money myths. Online scams, crypto pumps, hype investments distract us. Same with stocks. Day trading volatile shares can yield $1,000 to $5,000 in a week, but most lose within a month. Yet long-term investors who buy solid companies or index funds grow wealth slowly but steadily. Example, investing $10,000 in S&P 500 in 1990 would now be worth over $120,000. Slow, boring, but effective. Key takeaway. Fast money excites, slow money builds. Online hype, crypto pumps. Viral success stories mislead our psychology. FOMO and survivor bias trick the mind. Most never see the failures. 90% of overnight millionaire stories are luck-driven, not skill-driven. Offline businesses, real estate, long-term investing are proven. Sustainable paths, question to you: would you rather risk $1,000 on meme coins hoping for $50,000? Or invest $1,000 in a franchise or ETF, growing slowly to $5,000 to $10,000 in a few years? Dopamine loves the first. Discipline rewards the second. Humorously, most of us still chase dopamine, swipe, watch, invest emotionally, lose, rinse, repeat. Even seasoned investors get caught. But understanding psychology helps. House money effect, FOMO, survivor bias, dopamine spikes. These explain why easy money feels so good yet disappears. Final lesson: real wealth is boring, slow, invisible. It takes discipline, patience, systematic investment, reinvesting profits, building offline and online businesses, diversifying assets, understanding market cycles, respecting compounding, avoiding hype, ignoring social media dopamine traps. If you apply these principles consistently for 5, 10, 20 years, small contributions grow into multi-million-dollar portfolios. Your financial freedom becomes stable, sustainable, predictable. Unlike hype stories that vanish overnight, treat money as a tool, not a toy. Focus on systems, habits, learning, not luck or hype. The sooner you start, the more time your wealth has to grow. Compound interest is your silent millionaire. Patience is your secret weapon. Consistency is your superpower. And if you want to truly understand how money works, how markets move, how to make smart investments, and see behind the illusion society pushes, subscribe.